Hello friends, in this video I'm going to discuss the various business forms. For federal income tax purposes, the distinctions among various forms of business organization are very important. And business operations can be conducted in a number of different forms. Among various possibilities are the following: sole proprietorship, partnerships, trusts and estates, S corporations, regular corporations, also called the C corporations. Let's discuss each of the various business forms in some detail. So the first one is sole proprietorship. A sole proprietorship is not a taxable entity separate from individual who owns the proprietorship. The owner of the sole proprietorship reports all business income and expenses of the proprietorship on Schedule C of Form 1040. The net profit or loss from the proprietorship is then transferred from Schedule C to Form 1040, which is used by the taxpayer to report the taxable income. The proprietor reports all of the net profit from the business, regardless of the amount actually withdrawn during the year. Income and expenses of proprietorship retain their character when reported by the proprietor. Partnerships. Partnerships are not subject to federal income tax. However, a partnership is required to file a Form 1065, which reports the results of the partnership's business activities. Most income and expense items are aggregated in computing the ordinary business income or loss of the partnership on Form 1065. Any income or expense items that are not aggregated in computing the partnership's ordinary business income or loss are reported separately to the partners. Some examples of separately reported income items are interest income, dividend income, and long-term capital gains. The partnership's ordinary business income loss and separately reported items are allocated to partners according to the partnership's profit and loss sharing agreement. Each partner receives a Schedule K1 that prepares the partner's shares of partnership, ordinary business income loss, and separately reported income and expense items. Each partner reports these items on his or her own tax return. Now let's talk about corporations. Corporations are governed by Subchapter C or Subchapter S of the IRC, that is the Internal Revenue Code. Those governed by Subchapter C are referred to as C corporations or regular corporations, and corporations governed by Subchapter S are referred to as S corporations. S corporations, which generally do not pay federal income tax, are similar to partnerships in that ordinary business income or loss flows through the shareholders to be reported on their separate returns. Also, like partnerships, the S corporations do not aggregate all income and expense items in computing ordinary business income or loss. Certain items flow through the shareholders and retain their separate character when reported on the shareholders' returns. The S corporation ordinary business income loss and separately reported items are allocated to the shareholders according to their stock ownership interests. Unlike proprietorships, partnerships, or S corporations, C corporations are subject to entity level federal income tax. This results in what is known as double taxation effect. A C corporation reports its income and expenses on Form 1120. The corporation computes tax on the taxable income reported on the Form 1120. When a corporation distributes its income, the corporation's shareholders report dividend income on their tax returns. Thus, income that has already been taxed at the corporate level is also taxed at the shareholder level. The effects of double taxation are what distinguishes the C corporation from the other kinds of business entities. As noted earlier, the income of the C corporation is subject to double taxation, which stems in part from the fact that the dividend distributions are not deductible by the corporation. Shareholders of closely held corporations frequently attempt to circumvent this disallowance by disguising the dividend distribution as some other purported transaction. One of the more common ways of disguising dividend distribution is to pay excessive compensation to shareholder employees of closely held corporations. The IRS scrutinizes compensation and other economic transactions, example loans, leases, and sales, between shareholders and closely held corporations to ensure that the payments are reasonable in amount. Double taxation also stems from the fact that dividend distributions are taxable to the shareholders. Now let's do some comparison of corporations and other forms of doing business. Consideration of the tax factors require an examination of the corporate rate structure. Any attempt to take advantage of difference between the corporate and the individual marginal tax rate must be considered for the double taxation effect. Unlike other forms of business, the tax attributes of income and expense items of C corporations do not pass through the corporate entity to the shareholders. As a result, if the business is expected to generate tax-favored income, such as long-term capital gain, one of the other non-C corporation forms of business may be desirable. Losses of the C corporation are treated differently from the losses of proprietorship, partnership, and S corporation. A loss incurred by the proprietorship may be deductible by the owner because all income and expense items are reported by the proprietor. The partnership losses are passed through the partnership entity and may be deductible by the partners, and the S corporation losses are passed through to the shareholders. C corporation losses, however, have no effect on the taxable income of the shareholders. Therefore, one of the non-C corporation forms of business may be desirable if the business losses are anticipated. The net income of proprietorship is subject to the self-employment tax, as are some partnership allocations of income to partners. In the alternative, wages paid to the shareholder employee of the corporation, either C or S, are subject to payroll taxes. The combined corporation employee payroll tax burden should be compared with the self-employment tax associated with the proprietorship and partnership forms of business. This analysis should be included in the benefit of the deduction available to the corporation for payroll taxes paid, as well as the deduction available to the individual for the part of the self-employment taxes paid. At the entity level, state corporation income taxes or franchise taxes are applicable for businesses formed as corporations. Although no entity level federal income tax is typically assessed on S corporations, limited liability companies, or partnerships, a few states impose a corporate income tax or franchise tax on such business forms. Consideration of state taxation when selecting a business form is particularly relevant for businesses that operate in more than one state. Now let's discuss the non-tax considerations in selecting the form of business. Non-tax considerations will sometimes override tax considerations and lead to the conclusion that a business should be operated as a corporation. Following are some of the more important non-tax considerations. Sole proprietors and general partners in partnerships face the danger of unlimited liability. That is, the creditors of the business may file claims not only against the assets of the business but also against the personal assets of the proprietors or general partners. State corporate law protects shareholders from claims against their personal assets for the corporate debts. The corporate form of business can provide a vehicle for raising large amount of capital through widespread stock ownership. Most major businesses in United States are operated as corporations. Shares of stock in the corporation are freely transferable, whereas a partner's sale of his or her partnership interest is subject to approval of the other partners. Shareholders may come and go, but the corporation can continue to exist. Death or withdrawal of a partner, on the other hand, may terminate the existing partnership and cause financial difficulties that result in dissolution of the entity. This continuity of life is distinct advantage of the corporate form of doing business. Corporations have centralized management. All management responsibility is assigned to the board of directors, which appoints officers to carry out the corporation's business. Partnerships, by contrast, may have decentralized management, in which every partner has the right to participate in the organization's business decisions. Limited partnerships, though, may have centralized management. Centralized management is essential for smooth operation of widely held business. Limited liability companies, LLCs. The use of the limited liability company form has proliferated greatly in recent years, particularly since 1988, when IRS first ruled that it would treat qualifying LLCs as partnerships for tax purposes. All 50 states and District of Columbia have passed laws that allow LLCs, and thousands of companies have chosen LLC status. As with the corporation, operating an LLC allows its owners or members to avoid unlimited liability exposure, which is a primary non-tax consideration in choosing this form of business organization. A major tax advantage of LLCs is that qualifying businesses may be treated as proprietorships or partnerships for tax purposes, thereby avoiding the problem of double taxation associated with regular corporations. Some states allow an LLC to have centralized management, but not continuity of life or free transferability of interests. Other states allow LLCs to adopt any or all of the corporate characteristics of centralized management, continuity of life, and free transferability of interest. Now we are going to discuss the income taxation of corporations, and we are going to compare it with the individual tax treatment. Let's talk about some similarities. The gross income of the corporation is determined in much the same manner as it is for individuals. The gross income includes compensation for services rendered, income derived from a business, gains from dealing in property, interest, rents, royalties, and dividends, to name only a few items. Both individual and corporations are entitled to exclusions from the gross income. However, corporate taxpayers are allowed fewer exclusions. Interest on municipal bonds and life insurance proceeds are two exclusions that are applicable to both individual and corporate taxpayers. Gains and losses from property transactions are handled similarly. In the area of non-taxable exchanges, corporations are like individuals in that they do not recognize gain or loss on a like-kind exchange and may defer realized gain on an involuntary conversion of property. The exclusion of gain from the sale of personal residence does not apply to corporations. The disallowance of losses on sale of property to related parties and on wash sales of securities apply equally to individuals and corporate taxpayers. The business deductions of corporations are also parallel to those available to individuals. Deductions are allowed for all ordinary and necessary expenses paid or incurred in carrying on the trade or business. Specific provision is made for deductibility of interest, certain taxes, losses, bad debts, cost recovery, charitable contributions, net operating losses, research and experimental expenditures, and other less common deductions. There is no distinction between the business and non-business interest or business and non-business bad debts for corporations. Thus, the individual corporations are not allowed a deduction for interest paid or incurred on amounts borrowed to purchase or carry tax-exempt securities. The same holds true for expenses contrary to public policy and certain accrued expenses between related parties. Some of the tax credits available to individuals, such as the foreign tax credit, can also be claimed by the corporations. Let's talk about the dissimilarities. The income taxation of corporations and individuals also differ significantly. As noted earlier, different tax rates apply to corporations and to individuals. All allowable corporate deductions are treated as business deductions. Thus, the determination of the AGI, so essential for individual taxpayers, has no relevance for corporations. Taxable income is computed simply by subtracting from gross income all allowable deductions. Itemized deductions, standard deduction, and the deduction for personal and dependency exemptions do not apply to corporations. Let's look into the accounting periods and methods. Accounting periods first. Corporations generally have the same choices of accounting periods as do individual taxpayers. Like an individual, a corporation may choose a calendar year or a fiscal year for reporting purposes. Corporations usually can have different tax years from those of their shareholders. Also, newly formed corporations as new taxpayers usually may choose any approved accounting period without having to obtain the consent of the IRS. Personal service corporations and S corporations, however, are subject to severe restrictions in the use of fiscal years. Accounting methods. As a general rule, the cash method of accounting is unavailable to corporations. However, several important exceptions apply in the case of following types of corporations: S corporations, corporations engaged in trade or business of farming or timber; qualified PSCs, corporations with average annual receipts of 5 million or less for most recent 3-year period. Regardless of these exceptions, most individuals and corporations that maintain inventory for sale to the customers are required to use accrual method of accounting for determining the sales and cost of goods sold. However, as a matter of administrative convenience, the IRS will permit many taxpayers to use cash method for determining the sales and cost of goods sold. This includes any entity with average annual gross receipts of not more than 1 million for most recent 3-year period, and some entities with average annual gross receipts of not more than 10 million for same 3-year period. A corporation that uses accrual method of accounting must observe a special rule in dealing with cash basis related parties. If the corporation has an accrual outstanding at the end of the taxable year with respect to such a related party, it cannot claim a deduction until the recipient reports the amount of income. This rule is most often encountered when corporation deals with the individual who owns directly or indirectly more than 50% of the corporation's stock. Capital gains and losses. Capital gains and losses result from taxable sales or exchanges of capital assets. Whether these gains or losses are long-term or short-term depends upon the holding period of the asset sold or exchanged. Each year, a taxpayer's short-term gains and losses are combined, and long-term gains and losses are combined. The result is a net short-term capital gain or loss and a net long-term capital gain or loss. If gains and losses result, example, net short-term capital gain and net long-term capital loss, such amounts are further netted against each other. If instead the results are all gains or all losses, no further combination is necessary. Capital gains. Individuals generally pay a preferential tax rate of 15 to 20% on net capital gains. Corporations, however, receive no preferable tax rate on long-term capital gains, and such income is taxed at the normal corporate tax rates. Capital losses. Net capital losses of corporate and individual taxpayers receive different income tax treatment. Generally, individual taxpayers can deduct up to 3,000 of such net losses against other income. Any remaining capital losses are carried forward to the future years until absorbed by the capital gains or by the $3,000 deduction. Loss carryovers retain their identity as either long-term or short-term. Unlike individuals, corporate taxpayers are not permitted to deduct any net capital losses against ordinary income. Capital losses, therefore, can be used only as an offset against capital gains. Corporations, however, carry back net capital losses to 3 preceding years, applying them first to the earliest year in the point of time. Carry forwards are allowed for the period of 5 years from the year of the loss. When carried forward or backward, a long-term capital loss is treated as a short-term capital loss. Passive losses. A passive loss rules apply to individual taxpayers and to closely held C corporations and personal service corporations. For S corporations and partnerships, passive income or loss flows through to the owners, and the passive loss rules are applied at the owner level. The passive loss rules are applied to closely held C corporations and to PSCs to prevent taxpayers from incorporating to avoid the passive loss limitations. A corporation is closely held if any time during the last half of the taxable year more than 50% of the value of the corporation's outstanding stock is owned directly or indirectly by or not more than 5%, 5 individuals. A corporation is classified as a PSC if it meets the following requirements. The principal activity of the corporation is the performance of personal services. The services are substantially performed by shareholder employees. More than 10% of the stock in value is held by the shareholder employees. Any stock held by an employee on any one day causes the employee to be the shareholder employee. Similar to the individual taxpayers, the PSCs generally cannot deduct passive losses against either active income or portfolio income. The application of the passive loss rules is not as harsh for the closely held C corporations. They may offset passive losses against net active income, but not against portfolio income. Charitable contributions. Both corporate and individual taxpayers may deduct charitable contributions if recipient is qualified charitable organization. Generally, a deduction will be allowed only for the year in which the payment is made. However, an accrual basis corporation may claim deduction in the year preceding payment if two requirements are met. First, the contribution must be authorized by the board of directors by the end of that year. And second, it must be paid on or before the 15th of the third month of next year. Generally, a charitable contribution of property results in a deduction equal to the property's fair market value at the end of the gift. As a result of this rule, a contribution of loss property fair market value less than basis should be avoided as a loss inherent in the property would never be recognized. A sale of the property to recognize the loss, followed by the charitable contribution of the sale proceeds, would produce more favorable tax result. Fair market value also is the valuation amount for most charitable contributions of capital gain property. Capital gain property is the property that, if sold, would result in long-term capital gains or 1231 gain for the taxpayer. The deduction for charitable contributions of capital gain property to certain private, non-operating foundations is also limited to the basis of the property. As a general rule, the deduction for the contribution of ordinary income property is limited to the basis of the property. Ordinary income property is appreciated property that, if sold, would not result in long-term capital gain for the taxpayer. On certain contributions of inventory by corporations, however, the amount of the deduction is equal to the lesser of the sum of the property's basis plus 50% of the appreciation of the property or twice the property's basis. There are some limitations that are imposed to the charitable contribution deductions on the corporate level. Like individuals, corporations are subject to percentage limits on charitable contribution deduction. For any tax year, a corporate taxpayer's contribution deduction is limited to 10% of the taxable income. For this purpose, the taxable income is computed without regard to the charitable contribution deduction, any net operating loss carryback or capital loss carryback, dividends received deduction, and domestic production activities deduction. Any contributions in excess of 10% limitation may be carried forward to 5 years succeeding tax years. Any carry forward must be added to subsequent contributions with the subject to 10% limitation. Net operating losses. As for individuals, the net operating loss of a corporation generally may be carried back 2 years and forward 20 to offset taxable income for those years. Similarly, corporation also may elect to forego the carryback period and just carry forward the net operating loss. Unlike individual taxpayers, however, a corporation does not adjust its tax loss for the year for capital losses because a corporation is not permitted a deduction for net capital losses. Nor does the corporation make adjustments for non-business deductions as individual taxpayers do. There are certain deductions that are specific to the corporate taxpayers. Provisions applicable only to corporate taxpayers include the dividends received deduction and the organizational expenditures deduction. Dividends received deduction. The purpose of dividend received deduction is to mitigate multiple taxation for corporate income. Without the deduction, income paid to the corporation in a form of dividend would be taxed to the recipient corporation with no corresponding deduction to the distributing corporation. Later, when the recipient corporation paid the income to its shareholders, the income would again be subject to taxation with no corresponding deduction to the corporation. The dividends received deduction alleviates this inequality by causing only some or none of the dividend income to be taxable to the recipient corporation. This table illustrates the amount of dividend received deduction depends on the percentage of ownership recipient corporation shareholder holds in domestic corporation making the dividend distribution. Percentage of ownership by corporate shareholders and the deduction percentage. If it's less than 20%, then the deduction percentage is 70%. If it's 20% or more but less than 80%, then the deduction percentage is 80%. If the percentage of ownership by corporate shareholders is 80% or more, then the deduction percentage is 100%. The dividends received deduction cannot exceed the taxable income limitation. This limitation is equal to the corporation's taxable income multiplied by the percentage that corresponds with the deduction percentage. Thus, if the corporation shareholder owned less than 20% of the stock in the distributing corporation, the dividends received deduction is limited to 70% of the taxable income. Following steps are useful in applying these rules. First, multiply dividends received by deduction percentage. 2. Multiply taxable income by deduction percentage. 3. Subtract 1 from the taxable income. If the entity has income before dividend received deduction, but the dividends received deduction creates net operating loss, the amount in 1 is the dividend received deduction. If the dividend received deduction does not create the net operating loss, the deduction is limited to lesser of 1 or 2. The second type of deduction that is available only to the corporation is the organizational expenditures deduction. Expenses incurred in connection with the organization of the corporation normally are chargeable to the capital account. That they benefit the corporation during the existence seems clear. Under Section 248, a corporation may elect to amortize organizational expenditures over 180-month period, beginning with the month in which the corporation begins its business. Organizational expenditures include following: legal services incident to organization, example, drafting the corporate charter, bylaws, minutes of the organizational meetings, and terms of the original stock certificates. Necessary accounting services, expenses of temporary directors and the organizational meetings of directors and shareholders, and the fees paid to the state of incorporation. Expenditures connected with issuing or selling of shares of stock and other securities or with the transfer of assets to the corporation do not qualify. Such expenditures reduce the amount of capital raised and are not deductible at all. The startup expenditures can be treated in same manner as organizational expenditures. Up to $5,000 can be immediately expensed, subject to the dollar cap, and excess of $50,000 phase out. Any remaining amounts are amortized over the period of 180 months.